On this week's episode of the Financial Freeman Podcast, we will give a beginner's guide to inflation and explain why it's absolutely vital that you know what it is for your financial future. My name is Gary Freeman. I'm a former corporate lawyer and now finance educator, mentor and investor.
My name's Ronnie Freeman. I'm a property developer, artist and interior designer. And we will start with our news story of the week. What have we got this week?
This week is all about inflation, funnily enough.
Oh, that's links.
Yeah, exactly. And it was actually last week's piece of news, but it is that inflation is now at 2.5% as measured by what they call the Consumer Price Index. And that's actually the highest it's been for years.
What, in the last year it's gone up 2.5%?
Yeah, exactly. Since last year it's gone up 2.5%. And there's a couple of notable things that have gone up. One of them is second-hand cars, which is very interesting. Usually you'd expect second-hand cars to go down in price. And because they sort of cars lose value because they've been used. The more they're used, then they tend to lose value. But there is a shortage currently of what they call semiconductors, which means that new cars have become a lot more expensive. You need semiconductors in cars. And therefore,
do you know why?
Not really. I'm not a car expert, but that has had a knock-on effect for the second-hand car market.
Why is there a shortage in semiconductors?
Because lots of people want them they're in lots of different things: phones, cars, everything. So there's just a general shortage at the moment.
Wait, so there's a shortage of semiconductors. So why the cars already have semiconductors in? So that should mean a shortage.
Well, some, but they can't make new cars fast enough. So they're not creating new. So there's a shortage
in selling.
Exactly.
Right.
So there's not enough new cars to sell, and therefore the price of second-hand cars go up. Okay. So that leads us very nicely on to the topic of the week, which is inflation. Now, inflation very, very broadly means that the prices of goods are going up, or really it means that the value of your money is going down. Okay. So can you think of something that's gone up a lot since your childhood that you still?
Freddos.
How much do Freddos used to cost?
10p.
And now?
I don't know. More than 10p.
Right.
If you would have told me to do my research.
Well, I just thought I'd put you on the spot because I've got one which is the bus price. I remember when we used to go to school and we used to give in a clipper card. And there was one bus driver anyway who never used to clip your card, but that's another story. But it used to cost about 30p for a bus ride. And
kids fare.
It was kids fare, but
at least a pound
I think
now.
Even the adults was not much more than that. And now the price of a bus fare is about £3
for a kid
for adult journey. So I think the adults.
You can't compare kids.
Yeah, the adult was about 50p at the time. So the adult was 50p, kids
6
30p,
times inflation,
which is mad. I didn't go to school that long ago, quite long ago.
You can really wage if you like.
Yeah. So it's huge increase that we're talking about for something like that, and I'm sure everyone has got an example. And I guess the question on the top of your head must be, well, what's going on here? Why is that bus ticket costing so much more? It's something you probably just accept, and it's just a way of life. And we want to discover in this episode why that's happening. And then in the next couple of episodes, we'll discuss how you can basically win from this, and unfortunately why so many people lose as a result of this. Okay? So there's really sort of 3 factors into why the prices go up. Now, 2 of them are fairly combined, and they result in either sort of short-term inflation or deflation, and the other one is much more important and is the reason why inflation will probably and almost inevitably keep going up and up. The 2 short-term factors, and just before we kind of discuss inflation, does it make sense what deflation is?
Well, it makes sense, but I've never witnessed it.
So deflation is the opposite, where prices are going down in value.
Does that happen?
That has happened, and we'll discuss, when we come on to the government, we'll discuss a bit more about deflation. But just bear in mind, that is obviously the opposite of inflation. That's where prices are actually coming down. So the 2 main short-term factors, anyway, that we'd like to discuss for inflation are sort of costs going up, cost increase, and that obviously leads to the businesses raising their prices. So they don't want to, but let's just say you are selling a mobile phone and the cost of copper or whatever else that goes into that mobile phone goes up. you have two choices, and that's to keep the price the same and make less of a profit, or you're going to increase the price and make the consumer pay. And almost inevitably, it's the second one that happens. So it's the cost of supplies that are going up. Now, the cost of supplies going up sometimes is linked to demand. So the two are definitely combined, but we'll just slightly keep them separate just for ease. So it's not just the supplies that go into goods. It can be wages, for example. So it could be that there's less employees that want that particular job, and therefore you have to pay them more. There might be, for example, an older workforce, so again, less employees. And so there's various different costs that go into eventually sort of making a product. And the basic information is that if they go up, then the prices are inevitably going to go up.
So why has the virus made everything shoot up?
So there was a lot of shortages for various different things. Now, a lot of this is to do with sort of globalization. It's two things. So first of all, the world had to shut down. So lots of these production lines all had to stop working. Obviously, there was really, really big threat at the start of the virus. So lots of places closed for good. So the supply levels go down. Okay, so it becomes a lot harder to supply everything. So that's a supply constraint, and therefore, obviously, if there's less of something, then there's in the same amount of demand, then that's chasing less supply, which means the price goes up. Okay, and the other thing is basically globalization, and that in a nutshell means that the world was very open about, say, 5 years ago. Lots of trade going everywhere. That started actually to happen before the virus started to slow down. The countries became a bit more insular. Now, especially when since the virus, trade has become a lot harder. Essentially, there's just been more of a trend towards looking after number one. Whether it's for the vaccines or tests or whatever, it's like, I want to make sure our country has enough. And that, again, is a constraint on supply, bringing prices up. Okay?
Right.
That makes sense?
Yeah.
Okay. So supply is number one. And
so
then
why 5 years ago did all the countries think?
It was just because it should work better for everyone, actually. And it comes in transies, and that's probably there's probably books out there, and I'm not 100% sure, but you just have to acknowledge that supply costs are a big factor, certainly for short term. And the second really is demand. And there's two sort of examples I'd like to give here. So the first one is where demand goes down dramatically. Now, this happened in oil prices at the start of the pandemic. Essentially, no one could drive, no one could travel, so driving was a lot lower, and flights were a lot lower. And this pushed down the oil prices to actually became negative prices. So actually, if you wanted to go and buy some oil, technically they would give you money to have some oil.
Not really.
Yeah, actually, that's what happened.
Not if you went to.
Not if you went to the shop. Not your vegetable.
No, because it could be because.
And not from the pump.
Because it was costing them money to store
exactly.
It. Well, you didn't say that.
Okay, but that's actually the price of oil for on the markets were in negative. So not the price for the consumer, but the price on the markets went into negative.
So they're paying you to take the oil away.
Exactly, and that was very, very temporary. But that's the example of demand going down, and there's loads of examples, obviously, of demand going up. I know my mother struggled to get garden furniture, for example, and that meant that because there just weren't enough. And therefore demand grew. Everyone wanted to be outside. You couldn't go inside to have guests, etc. So demand goes up, and therefore prices went up. So you've got the supply side and the demand side, and often, again, as I said, they work together.
Right.
All good so far. Okay,
yeah.
And that's led basically to the position that we're in now. But the main encompassing factor to all of this is what the government want from all of this. And they are targeting now 2% inflation every single year. Okay, for eternity. That's their target. Now, it's a target they've given the Bank of England.
Is that like quite... What's the average rise in a year?
So the average rise for the last number of years has actually been below that. Okay, Their target is about 1% or even below. So their target has been 2% actually since, unofficially since about 1996, I think. They first brought in this 2% target. But officially this is America anyway.
Why
Well, I'll tell you why they brought in a target, because it doesn't, that to me is, I've been researching this quite a lot. It's a strange thing. Why bring in this target? So it all stems back from their fear that if prices...
It's the UK government.
Yeah, UK, but US is very, very, very similar. We essentially follow their trend. The fear from the government is, so this is the official line, I don't quite believe it. The official line is that if prices are going down, so if there's deflation, okay, then people will hold off spending and the economy then struggles as a result. If people aren't spending, then eventually companies make less profit, people lose jobs, and it's a never-ending cycle. But I don't really buy that, because let's just take a car, for example, and let's just say it's a £10,000 car, okay, and I wanted a car. So that price that was £10,000 suddenly becomes 9,800. Okay, in the deflation world. Well, if I wouldn't hold off on buying that car if I wanted the new car that year. Now, I don't really care about new cars, but that's beside the point for now. So I wouldn't think, right, but it's going to be 9,600 or 9,500, whatever it might be, the year after. I would go and... Some might, but I don't think many would actually hold off. I think you'd actually get people spending.
Especially with houses.
Yeah, okay, houses is possibly different because, again, of the prices, but I don't think it would really stop people buying. And there are reports into this that when there used to be deflation, or deflation was a lot more common, economic activity was still absolutely fine. So
when was the deflation?
There's been deflation certainly before 1971. So 1971,
don't remember that.
It's a whole new topic. But basically, the currency, the dollar, was no longer tied to gold. And I don't want to go down there, but the world has changed a lot since 1971. Okay, and we'll discuss it more in depth. But there used to be a lot more deflation, and the world was still fine. I think it's a good thing for consumers. If prices are going down, then happy days. Now, yes, if prices are suddenly dropping 5-10%, you may hold off that purchase. I just don't see it if it's, say, 1% or 2%, which it ought to be if the government didn't interfere. So the reason why the government want this, they also say it's to essentially just trigger spending and bring an more upbeat economy. Because, again, if people are spending, then obviously that creates things. And if prices are going up, then wages are going up and everyone feels happy. Again, I don't really buy that, and I don't really buy why it has to be 2%. Okay, for certain times, in certain years, maybe it's necessary, but to have it as a target, to me, seems far too kind of extreme. So the real reason they need to do it is to bring the level of their debt down.
And how do you know that?
It's the only way they can bring their debt down.
But they're not going to announce that, so you just speculating that.
I'm speculating, but it's sort of financially, it's accepted out there financially that the only way, this is what they did in 1950s, the debt level of debt was so high because they borrowed for the war. They then inflated it away. That's the only way. I mean, not completely. There's actually still some debt, but from the war. They've only just paid off a few years ago. Now the First World War. So this is how kind of long it takes to pay off. Exactly. So the only way they can bring down the level of debt is by inflation. And essentially, I just want to kind of clarify what we're talking about here. They can't raise taxes. Well, they can raise taxes, but actually, we'll cover in another episode why actually raising taxes has such a minimal effect on the level of debt, because the level of debt is so huge now. Raising income tax, unless they suddenly kind of said you've got to give all your money to tax, which may be the way it's going, that wouldn't actually have the effect that is needed. So the value of that debt needs to go down, and it needs to be, say the debt is, I don't even know what it is, say it's 300 billion. In today's value, it will still be 300 billion in 10 years' time, but with inflation, the value of that debt is going down.
We'll all be billionaires. Yay.
We'll all be billionaires by paper, but it won't mean anything as much because actually that value is going down. Okay, so that's the critical thing to know. The government need inflation to reduce the level of debts that we're talking about. Now, you may say that, inflation is rising. They're going to stop all of this because they know that it's going to go out of hand. Okay, it's already above 2%. It was 2.5% last month. So game over. Not quite. Okay, their only real other mechanism to all of this, if they to stop inflation going out of control, and it gets a bit more complex here, is to raise interest rates. Okay, now this.
Just say again.
The only real mechanism they have to stop inflation. Okay, so they need inflation at the moment. That's their only tactic. But the problem is that we're already above target. Okay, so then what do you do?
How are we above target?
Because last month it was 2.5%.
Yeah, but who's in control?
The Bank of England, who are independent from the government. But you don't really need to know that. They actually are one of the same.
England, do they tell Tesco what to charge the bread at?
There's a base rate, yes. So effectively, yes. Wow. There's a bank, they set interest rates. So, but if you increase interest rates, okay.
What's that got to do with bread?
Right, if you increase interest rates, okay, the level of your mortgage, for example, will find its way to go up. Okay, so you're less likely to go and buy a house. You're less likely to, you're paying more on your debt. Okay, so you've got less money in your bank account and you're more likely to save. So increasing interest rates cools down the economy. Okay, so you've suddenly gone from heating up with inflation. As soon as you raise interest rates, it cools down.
What? So increasing interest rates makes deflation?
More of a deflation environment, or decreases inflation anyway. You might not get to below zero, but
no one's buying
because people aren't buying because actually.
So they drop the prices to make you want to buy.
Exactly. Okay. Because people have got less money essentially in the system. Now the reason why that this won't happen is because if interest rates go up, then the government's debt, they're paying more interest on that debt. They've got all this huge pile of debt. They don't want that. Okay, and it means the principal, the actual amount they owe, is
like
worth
the Bank
more.
of England and the government of it like that.
Essentially, yeah. For the purposes of this, they are one and the same. I'm sure there's arguments one way or the other, but I see them as the same. So they don't want to increase interest rates, and certainly not at the moment when we've just come through a pandemic, and actually they're trying to improve everyone's morale, and so they'll let this roll, and they've already said they see kind of the supply and demand side of things quietening down, and that might be right. But they're still pumping money into the...
They want people to buy, right?
Yeah.
But people aren't buying because they're saying all the shops, the retail's down. So why are they... No,
retail's still up. We discussed this a couple of weeks ago.
Just foot flows.
Just foot flow, yeah, but everyone's buying online. Prices are going up, the economy's doing well, and people are going out for dinner, etc. So it is...
Really?
Yeah. The stats say that. Or certainly drinking again. There is inflation. You've seen it's gone to 2.5% last month, so it's definitely there. They don't want to increase interest rates for the reason we discussed, certainly not at the moment. So they've said that their new approach is, instead of being 2%, that's 2% on average. And they've not said over how many years, but essentially what they mean is that they're going to let this roll possibly for 2-3 years. Even if it's at 4-5%, they'll still argue, well, it might be 2% over the long run, because remember, we've had less than 2% in previous years, and everything will be hunky-dory. Okay? So you've then got higher inflation over a longer period of time, and the government are telling you that is basically what is happening. Get used to it. Okay, even last month there was
so there's nothing you can do.
Well, nothing. Yeah, I don't think there's anything you can do. Even last month there was an interview by one of the Bank of England governors who's actually leaving. He said, "Yeah, we kind of know, but we've got no plans to increase interest rates. So currently the base rate is 0.1%. That's staying." Okay. Now, this is crucial. I hope you've learned in this...
Say that again. No plans to increase
There's no place to increase interest rates at the moment,
said.
even though inflation is above target. Okay? So it's at 0.1%, which is what the base rate is. They should, to bring it down back to the below 2%, raise those interest rates, I don't know, to whatever, 0.25, 0.5. I don't know how it kind of fits in, but that's ordinarily... The mechanism they should be doing is to raise interest rates now. They are not going to be doing that. They might have to in 6 months' time. Let's see where we are. But that it certainly doesn't sound like they're going to do it enough to cool off the economy. So we are going to see higher interest. And now what you need to do is stay tuned next week and the week after, because next week we're going to discuss the losers as a result of this level of inflation. And the week after, we're going to discuss why property thrashes inflation. So you need to stay tuned and subscribe.
I can't wait.
To follow,
I can't wait.
To follow that as well.
I hope this 20 minutes was worth it for what I haven't learned. There's nothing we can do except hold on and
realise that inflation is there. That's all I wanted to get out of this
buy
episode.
Buy all the property before the third episode
because everyone's going to want to do it.
Right. So I will end this podcast with a quick disclaimer. The content of this podcast is for general information purposes and not a recommendation to act. Please contact us or an independent financial advisor if you would like to discuss further. You can contact us on gary.financialfreeman@gmail.com.
So thank you. Stay tuned next week and we look forward to seeing you then.
Bye.
Bye.